All right, let's dive right into this explainer. You know, tracking exactly what your money is doing can get pretty complicated, even if you follow personal finance closely. So, to make these mechanics incredibly simple and honestly kind of fun, we're going to use a minimalist, doodle-style stickman friend to guide us through. Let's get started. So, where is all your money gone? It's a question that creates major anxiety, right? And honestly, that makes total sense. Over half of all Americans admit they have absolutely no idea how the tax system actually works. It just feels like a complete mystery. Well, today we're going to visualize exactly how the whole shebang works. We're going to start by destroying a massive misconception. It's that persistent fear that getting a raise and moving into a higher tax bracket will actually leave you with less take-home pay. You've probably heard someone say, "Oh, I don't want to make more money, it'll put me in a higher bracket." Let's explore why the math on that is, well, totally wrong. To show you how this actually plays out, imagine our stickman is a single filer who just had a stellar year, earning exactly $100,000. Now, under the federal income tax system, that officially lands them in what's called the 22% tax bracket. So naturally, you might be thinking, okay, 22% of 100K, he owes the government 22 grand. But thankfully, no way. That is not how it works at all. The secret here is the word marginal. That 22% absolutely does not mean writing a massive check for 22 grand. A marginal tax rate is actually the specific rate applied only to each additional dollar you earn. It is not a flat percentage just slapped on to your entire income. Think of these brackets like a giant doodle staircase our stickman has to climb. You only pay the higher rates on the money resting on those specific higher steps, nowhere else. So first, there's a 10% rate on the money resting on the very first step. That's the first $11,600. Then, for the dollars resting on the next step, up to $47,150, it's 12%. It is only the dollars sitting way up on that top step, from $47,151 to the $100,000 mark, that actually get taxed at that 22% rate. So if you sit down and do the actual math, bucket by bucket, step by step, our earner is paying $17,500 in total taxes. Look at that difference. That is significantly less than the $22,000 myth that keeps people terrified of getting a raise. Which brings us to a crucial point, the effective tax rate. This is the true percentage of your total gross income that you actually end up paying. For our stickman, the marginal rate was 22%, but his effective rate, it's just over 17%, proving once and for all that turning down a raise because you hate tax brackets is a terrible financial move. Seriously, take the money. All right, now that we've climbed the bracket stairs without fear, let's look at the first tool our stickman can use to protect that hard-earned cash from that $17,500 bill. Picture a giant shield. We call this the tax deduction. You hear the term constantly, but let's see what it literally does to your wallet. A tax deduction basically acts like a shrinking ray. It shrinks your total taxable income before the government calculates what you owe. So if you apply a $1,000 deduction to a $100,000 income, the government effectively closes its eyes to that grand and only runs the staircase math as if you made $99,000. Now, these shields generally come in two forms. First, the government just automatically hands everyone a base shield called the standard deduction, based on your filing status. But if you have enough qualifying expenses and you're willing to track them, you can itemize to shrink your taxable pile even further than the standard amount. The great thing is you can shrink your income with things like HSA and IRA contributions, even if you just stick with that basic standard deduction shield. But you absolutely must itemize if you want to claim specific lifestyle deductions, things like charitable contributions, state and local taxes, or the mortgage interest on your house. Okay. While deductions act like a shrinking ray on your income pile, our next tool acts like a giant, powerful eraser on your actual tax bill. We're calling this tool number 2, the credit power-up. And honestly, it is a real game changer. See, a tax credit is a direct dollar-for-dollar reduction in the final amount of taxes you owe. So if our Stickman is staring down that final $17,500 tax bill and he gets a $1,000 tax credit, that eraser instantly wipes away $1,000 of the bill. He now owes exactly $16,500. Boom. And this brilliantly illustrates the difference. It's all about timing. Deductions protect your income before the tax math happens. Credits? They step in and slash the final bill after the math. Because credits wipe out the final bill dollar for dollar, they are absolutely crucial wealth-building tools. A fantastic real-world example of this power-up is the child tax credit. It acts as a direct bill eraser for parents and guardians. But to use it, you gotta meet a few specific requirements. You must be the parent or guardian, the kid has to be under 17, they must have a social security number, and they must be claimed as a dependent on your return. Hit those criteria, and you get to wipe away a chunk of what you owe. To wrap up this explainer, I want to leave you with this. Honestly, use every single deduction and credit at your disposal. Because remember, tax avoidance is completely legal. Tax evasion is not. Using these tools to legally lower your bill builds wealth, while trying to illegally evade taxes will just ruin it. So now that you know how the math works, what specific step will you take today to legally protect your next paycheck?
Freedom isn't given, it's built, and it starts with what you do next.